All right, recording started. All right, so once again, in the chat window is the link to the handouts and a little bit more. Let's see. So the theme for this month is how to consistently book profits in multiple market sectors, and this is using options. And the main thing about this is exactly what myself and Becky have been doing for almost 20 years now. And it basically comes down to approaching trading in a business-like manner and a very analytical manner, and not in a looks like, feels like, that type of touchy-feely type of thing. No, it's numbers. And we live and die by stats and numbers. And that's how we've been able to trade consistently, profitably. And it makes a huge difference. So let's scroll down a little bit here, and then we'll go through some of those numbers in a little bit. These are the only sectors which we trade with options. There is a massive amount of diversity and option pricing. So there's something here for everyone's financial account size. If you have a bigger account, then you can trade the bigger ETFs like the Dow, Nasdaq, and S&P, which is DIA, QQQ, and SPY. Those are bigger dollar options. We trade into money options only, never, never, never out of the money options. So we're looking at anywhere from $800, $900 to $1,800 or $2,000 for one contract. So those are the bigger dollar ETFs. So if you have a bigger account, you can trade those, not a problem. And they actually give you some of the best results. But option pricing for a contract in the money can range for these ETFs anywhere from $70 a contract up to $2,000 a contract. So there's something in there for everybody size account. All right. We don't do anything that's less than 84% wins, and that's dating back to 20 plus years, between 20 and 25 years of data on all the strategies we trade. We trade like a grouping of 6 primary strategies and then 2 additional strategies, which are purely for the Dow, Nasdaq, and S&P. I'm going to put the link back into the chat window if you new people came in. So the handouts, look to the chat window for the link to the handouts, and you can find it there. As we learned a long time ago, new people coming in won't see those previous links, so in the chat window. So I keep adding it there. All right, so these are all the sectors we trade. What I want to go through today on how we approach trading things from a very business-like manner and expectations. What you're seeing up on the screen right now is the Dow, Nasdaq, and S&P trades, which we have had valid since 2019. And although it says 2019 here, our data actually goes all the way back to 2000. So a few years back, I'd asked Becky to put together some spreadsheets showing historical trades going back several years so people can double check what they're doing versus what should have been happening, that type of thing. So she's kept that going. But our data actually goes back to 2000 with every valid trade for every single strategy. And Becky's the one who creates all these spreadsheets. She tracks everything. And we live and die by these numbers. If we don't have these numbers, we cannot trade. Okay, if we don't have these numbers, we can't trade. Um, we don't do anything where we don't have at least an expectation of 84% wins, because just based upon human error, tick error, and broker error and that type of thing, I'm figuring a 4% margin of error overall. Okay. So 84% is really 80%, 88 is really 84. So the higher the percentage wins we see with our strategies, it means the fewer losses. And the fewer losses you have, the more money you end up making. It's all about constantly booking profits. I've had some people who I took on as clients, and they become overly cautious. They'll place 2 or 3 trades and sit there and watch them for 2 months. And what if one of those 2 trades ended up being a loss? Well, what other trades have you put on over the last 2 months to give you offsetting wins? This is not investing. So once you start trading, it's constantly trading in an ideal world, you're putting on 8 to 10 trades a month in an ideal world, and those wins at 84 to 90 something percent overall win rate, the the amount of money you make from the wins offset the losses, and we're going to take a look at that dollars and cents in a little bit also on some historical trades. So we'll come back to this spreadsheet in a little bit. What I want to take a look at is a big look at the overall market right now, and then we'll come back to the business approach to trading. And this is one of the major ways we have been able to eliminate or minimize options expiring worthless because we only buy calls and puts. And I know many people have tried buying calls and puts, and time decay kills you, and that type of thing, and you don't know what to do. But this is not really an issue with us because we've been doing it for so long. We know how we do it and what we do it on actually works. And so we don't really have to stress about time decay about any one ETF, especially stocks, maybe ETFs, not at all. All right, so I'm going to change the share and let's take a look at the big picture. And along the way, if you have any questions, unmute, ask the question. If you raise your hand, I probably won't see it. So just unmute and ask a question and pretend you're like really here in person. All right, so I'm changing the share now, and we'll take a look at some big picture of the overall market. All right, so what you're seeing right now is a big picture chart of the S&P 500. This is a monthly chart, so every candle is 1 month of time. 1 month of time. Each candle is 1 month. Right now, we're back in 1998. This is 1998. The blue line is a 40 period moving average. Okay? 40 period moving average is the blue line. This orange colored line is an 8 period moving average. All right? People ask me why we have a 40 period moving average. We have a 40 period moving average on just about every chart you're going to see us use. Started doing that when we started following Oliver Velez. And he just would use a 40 period moving average on all his charts, and we ended up doing the exact same thing, and it worked for us. So anything that works for you, you keep it. You put it on the books, keep it. So it gives us a line in the sand. It gives us direction of trend. It helps us in those type of ways. When we're above or below, it gives us a directional bias, and direction gives us the directional bias. This is trending up, market's bullish, trending down, market's bearish, that type of thing. With the 40s on all of our charts. The 8 came from John Carter and Hubert Centers, tradethemarkets.com. And those are one of the people we first learned with, and trading, whether it's on whatever time frame, markets ride the 8, and they ride the 8. Whether it's daily, monthly, whatever, markets ride this 8 period moving average. This is monthly, it pulls back to the 8, pulls back to the 8, pulls back to the 8. All right, once it breaks down, it goes back up to the 8, 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 that type of thing. All right, so this is the market crash in 2001, that tech bubble burst, and this is what happened. We look for 2 consecutive closes below this 40, and we expect the market to go lower. The 2 consecutive close thing on the monthly chart is something I learned from another trading group that used that as part of their big picture market timing model. And it seemed to work pretty well for us using the S&P as the main timing thing. All right, so this is as it crossed back up above the 8. Once above the 8, it pulls back to the 8, pulls back to the 8, and now we're backing up in a bullish cross. This is 2004. So this is the crash in 2001, took a couple of years to recover, and now the 8 crosses back above the 40. And the 8 has stayed above the 40 for the last 20-something years, basically. The market has stayed bullish. Might have crossed briefly, but not for more than months. Okay, cross here and then cross back up. This was the 2008 debacle. We'll get to that in a minute. All right, so it rides the 8, rides the 8. For those longer term traders who look for big moves and they wait patiently, every pullback to the 8, monthly 8, is a potential trade. If you are buying shares, every pullback to the 8 is a potential trading opportunity, and take profit. You got to have a take profit point. So if you're just buying shares, a pullback to the 8 or a pullback to the 40, uptrending 40 is a buying opportunity. If we're trading options, we look for the option buy signals to be on a daily chart, but we'll see the market pulling back, pulling back, pulling back, and anywhere here you start seeing buy signals on a daily chart, lower time frame, get in. Okay, those will be tend to be much better trades, but we just keep pulling back to the 8 buy, back to the 8, back to the 8, and finally break down, and we drop to the 40, the first test of the 40, buying opportunity. But we,
Excuse me.
yeah.
Uh, what do you mean when you say ride the eight and pull back?
Okay, so right now this orange line is the 8 period moving average.
Okay.
So we're just riding it up. Every time it pulls back, we get on board again.
Okay.
Pulls back, we're just riding it on up until it's done. But this is longer term. It works on the short, lower time frames also. But I know we have some people who basically place a couple trades a year, which is fine, or they just buy shares, not even options. They're just investors, but they use this as an investment tool for their analysis. So they'll wait to buy shares when it pulls back to this level. And then they'll ride the shares up and they'll take some profit, move a stop up. So I know I have some people who just buy shares. They don't want to deal with options. So they just wait for the pullback and buy. And they might have a loss here, but they have all these wins along the way. One loss, big deal. It pulls back to the 40, two consecutive closes. A couple months later, we get the breakdown. This was 2008. The two consecutive closes was like foreseeing the future. Combine that with all the news out that was out with all the negative news, but once it broke down, this market dropped. Now, I have had people come to me and present to me trading systems that they've developed and ask me to critique it for them because they develop a nice long system for buying um, options on ETFs, and it's a long system. So when the market's going up, and okay, so I asked them, what was your back test period? The last, they tell me, well, we back tested the last 5 years and we have this win percentage or this profit potential and all that stuff. I'm like, great. Um, you back tested it for the last 5 years? Yes. So you back tested it during the last 5 years when the market did nothing but go up. They're like, yes. So of course your system is going to look really, really good if you only back test during a period when the market goes up. You're going to have a great long system that works when the market goes up. So I asked those people to go back to this time between 2007 and 2009 and back test their system. And how would it have done? And they changed their minds really fast. They would have blown out their accounts. If you're going to do a back test and analysis, make sure that whatever you're trading will not only not lose you money during this period, but will actually also make you money during this period. This is massive volatility. The market dropped literally 50%. There's a 50% drop in the overall market during this period. So whatever you're trading or back testing, go back to 2007 through 2009, back test whatever you want to trade, and make sure it works during this period. I know that our strategies did not give us a whole lot of buy signals during this period. Other systems give you multiple buy signals during this massive drop. Okay, and it just wiped out capital.
Okay, question. So when
Yeah,
you're back testing,
yeah.
like you were saying that the last 20 so years have been bullish except for that 2007 and 9.
Maybe
So
one period around 2015, 2016-ish. A little
okay,
bearish.
so I would say so a rule of thumb might be the back testing is of those parts that it didn't do well to see how you can make money in those periods that the market was wonky.
Oh, we make money with, see, we have strategies to short market tops, to buy market bottoms, to buy markets as the trend is going up, to buy markets as the trend has been established. And we have strategies to short markets as the markets are going down and to short markets as the bearish trend has been established. So we take trades at all different points in the market. That's how we trade it.
Okay.
So that's how, but So when we're buying market bottoms, there are no real, it's still 80 something percent wins. When we're shorting market tops, and it's still going to be 80 something percent wins. So
Okay.
that's how we trade. So we don't get a whole lot of fake out, but the key is consistency, and I'll show you that in a little bit. We'll go through some numbers and some of the other charts we have. But I want to go through the big picture first.
Okay.
So this was that debacle 2008. Took till 2009 to find a market bottom, back above the 8 again. Once again, we're riding the 8 all the way up, riding and every couple of years we'll have a pullback to the 40. But this 8 period move happens every couple of months in a pullback. And it'll freak people out a little bit once in a while because you'll see this big pullback and then people will be like, oh no, the market's going to go to zero again. No, just a regular market pullback. And these are the ones we look for, salivate for when this is happening. You look for long-term investors anywhere getting close to the uptrending monthly 40 is a long-term buying opportunity. Um, okay. Long-term buying opportunity, 2018, the market pulled back. This was COVID. This pullback lasted a whole 3 weeks. It was one of the biggest rallies ever after that. This is 3 weeks worth of pullback time. Pulled back to the 40, massive reversal. No two consecutive closes below, by the way. Um, this was 2022. During this time, always hear on different broadcasts, the market is now in a bear market. It's pulled back 10%. And people think, oh, that means it's going to go down forever. No, we're just pulling back. What's the price here? 470 something, and it pulled back to 370 something, 20 something percent pullback. Yeah, 20 something percent pullback. That happens pretty regularly. A 10 to 20 something percent pullback happens pretty regularly because markets can't go up forever. They pull back to support levels and go again. Massive opportunity whenever you see the pullback to the 40. Here's it's been right in the 8, right in the 8, right in the 8. Look at where we are right now. Remember a couple week or two ago, we had what people were calling a big pullback. A big pullback. The market dropped for like a couple of days. This is where we are. It's not a big pullback. It's just it might start something. I'm kind of actually hoping it does start something to get a deeper pullback because right now we have a lot of sell signals in play. Most of our buy signals, our longs have been exhausted, have already hit targets. And if you look at some of our videos from the last 2 months at our meetups, been focusing on options the last 2 months because of this time of year. Always say October through April is our most profitable time to trade. With September through no mid-November, 97 to 99% of our buy signals, our long trades, hit first targets. It's that high during that period. And that's exactly what's been happening during that period this year also. So we've exhausted the long trades. Only maybe one, maybe two still open. The rest are all short. So we have a whole bunch of short signals with a November expiration sitting out here right now. Okay. So and remember with the government shutdown, a lot of the economic announcements have not come out. Major market moving announcements have not come out yet. When they all suddenly come out, this market is going to move. Okay. But they've all been held back because of the government shutdown. So we got our first couple of sell signals right up here. But there's a monthly chart. We still have a couple of weeks left in the month. I'm kind of hoping we see a down move and a pullback. That would be ideal to set up for the end of year rally. But right now, this period we're in is just a beautiful time between September and November. And whenever we get buy signals, they've been the winners. And like I said, if you go back and look at our last couple of meetups, we went over end of year seasonal patterns. I think that might have been in the August meetup, and that recording is online on our YouTube channel. So watch that, and you'll see that where we went over that in detail, the end of year seasonal pattern between September and October. Take those trades, take those trades, take those trades when they come up if you're trading out strategies. All right, so that's that. Now I'm going to go back to um, the the handout a little bit here and take a look at that again. Okay. So just over the last couple of years, different people trade different things. We have 28 different ETFs, and some people like to trade energy ETFs. Some people like to trade the precious metals. Some people like to trade pharmaceuticals. Some people like to trade real estate. So what I did was I asked Becky to actually create different spreadsheets with the different type of trading results. I think I'll actually go to the actual spreadsheet and show you that. This is a snippet of the spreadsheet that's in the handout, so you can reference that. But I'll go to the actual spreadsheet. Okay, so here's the actual spreadsheet. So on our actual spreadsheet, we have all the trades listed that goes back through 2019. All the trades are listed and the win-loss status. So this first sheet is Dow, Nasdaq, and S&P. And so if you have a little bit bigger account and you can afford to trade the Dow, Nasdaq, and S&P, QQQ, DIA, and SPY, this actually gives you the overall best results. The old saying, if you have the more money you have, the more money you can make. That's totally true here. The more money you have, the more money you can make. If you can afford to trade these, beautiful. Consistency, and it works really well. So between 2019 and 2025, there's 91% winning trades. Trading all of our strategies as a group. Like I said, we have 6 primary strategies and then 2 additional ones just for the Dow, Nasdaq, and S&P. So realistically, you will not be in every single trade. Sometimes the pricing isn't just right, and that's I go over with people during coaching sessions. Sometimes open interest usually isn't an issue with the bigger ETFs, but sometimes the pricing isn't just right. You have to wait a little bit. Sometimes you might miss a trade. So, but if you can be as consistent as you can, take as many trades as you can, it's hard to go wrong trading this grouping of ETFs with these strategies. And this is all of our different strategies we're trading. So some people just like to trade the Dow, Nasdaq, and S&P. Dustin is one of those people who was talking earlier. He's just starting on options. He's going to be focusing on the Dow, Nasdaq, and S&P. I got a couple of other people doing the same thing because they've traded everything, but then they saw when they see all these numbers, this is the way to go if you can afford it. Okay, Praveen asking a question. Assuming you more than one strategy trigger, which one to trade? All of them. You mean trigger on one particular day or one today and one tomorrow? And if the trigger in one day, trade as much as you can afford to trade. The reality is, you might get the Dow, Nasdaq, and S&P all triggering longs on the same day. Although they're similar, they're different. If one is 84% wins, one is 88% wins, and one is 91% wins, and you can afford any one of them, which would your first choice be, Praveen? The 84%, 88%, or 91%? Which would your first choice be to trade? There you go. That's easy. And that's literally how you break it down. You're going to trade the one that has the highest probability of success first and foremost if they all trigger on the same day. And those are the numbers we provide to you every 3 months. Becky updates the trading plans and goes through all the trades so all these trades, Becky goes through all of them, updates the overall stats every 3 months, and we send that out in a trading plan every 3 months because you're going to need these numbers. So this number gets updated every 3 months for each ETF, for each strategy. Okay. I asked Becky to put together this one just to show how this grouping of ETFs performs. And this grouping of ETF performs extremely, extremely well. Extremely. So this is SPY, QQ, and DIA trading everything. That's trading all the valid strategies. So you can tell she's very numbers oriented. I don't do this, okay? I do not do spreadsheets. I am a person. I have a sheet of paper here next to my desk with all my trades and all my trades listed out here, how many contracts, everything, and it's written down. My entry, my target, my stop loss, everything is written on the sheet of paper. This is me. I don't spreadsheet, okay? Becky does the spreadsheeting. She does the tracking. Her background is in data management. That's what she does. So that's why we work together really well. I do the stuff like I'm in front of the camera, she's behind the scenes, and together we complement each other's skills and likes and dislikes. She does not want to be in front of the camera, and I don't want to be behind the scenes doing spreadsheets. So we work well together, but we need the spreadsheets and we need these
Excuse me.
numbers. Yep.
Hey, if I'm reading this right, is the first column, like on the left, is that one cycle? And then the one that has SPY under it, is that the second, like 2 cycles of time?
Everything, all any stats you ever see us put in print will be 2 cycles
Okay,
of time.
got it. Okay. So what's
And
the column to the left then? Right
this
there.
one,
Yep.
this is the overall between 2019 and 25 overall trade. This is 2025, 24, 23. So I break it down by individual year. So in like 2019 for SPY, this was the numbers.
Oh,
For
got it. Okay.
2020 for SPY, these are the numbers. And for 2024 for DIA, these are the numbers. So it's broken down by year and by overall.
I got it. The first column is all three of them together.
Yes, everything combined for DIA, SPY, and QQQ, everything combined. Yes.
Perfect. Thank you.
So, but knowing this is key. Now, not everyone can afford to trade this. So what we have is a couple other choices, XLI and XLK. XLI is industrials. Industrials about 93% correlated with DIA. Technology, XLK, is also about 90 something percent correlated with the NASDAQ, QQQ. Also extremely high win-loss percentages. Here are all the trades again listed out in the leftmost column, going back to 2019. Wins and losses, and here are the overall stats. So both very good, but much lower priced options. Um, They'll go from a couple $100s to a couple $100. You don't have to worry about these being $2,000 options, generally speaking. You're looking at between 300 and 800. It might be the range of the options, but this is more affordable for most people. It's not as high a percentage as DIA and QQQ, but still extremely good at 89, 90% wins. Extremely good. Okay? Extremely. So there's always choices for people what to trade. And let's say I go over to the precious metals, gold, silver, metals and mining, gold miners. Some of these have been my favorites to trade over time. People who want to trade this grouping of ETFs, here are the numbers. GDX, overall 87% wins since 2019. And like I said, these numbers actually go back to 2006 for these ETFs. For the big indices, it goes back to the year 2000 or 1999. So it goes back even further. But some of the ETFs have only existed since 2006-ish, 5 or 6. So we have stats from the time they became into existence. But you can see what the win-loss stats are for these over the last, since at least since 2019. So if you want to trade these, and like I said, we have this for all 28 ETFs. Energy, oil, gas. XLE is the energy ETF. This energy ETF is energy related companies, oil and gas exploration. ETFs. Another reason we trade ETFs, we don't have to worry about implied volatility. The implied volatility of an individual stock um, can really destroy our ability to make money when we get a volatility crush. And a big part of the pricing of the ETF, I mean, of the stock is implied volatility. Um, and leading up to earnings, it might get really high. Then right after earnings, like volatility just drops out and pricing drops. We don't have that same effect with the ETFs because that there's we don't get impacted by the volatility of any one stock. It's distributed among dozens to hundreds of stocks. So we don't get a volatility crush from earnings and stuff like that that you see with individual stocks. That's one of the biggest reasons we can just buy calls and puts on the ETFs and just focus on the sectors. If you want to trade stocks, great. You might have to do something different, but just buying the calls and puts works really well for us. It requires a lot less capital, and there's no limitations on how much we can make. I fundamentally do not believe in placing a trade that limits my ability to make money. When myself and Becky first started trading, we learned every complex option spread and strategy and adjustment you can think of. And we got good. I mean, really good. Good enough to never take a loss. That good. Okay. But here's the problem with that good. To not take a loss, meaning when a trade's going against you, you have to put more money into it to fix it. And as someone who wanted to be able to leave my full-time job, um, that's just seriously unrealistic. Where am I getting money from magically to fix a trade gone bad? Once you leave your job, your pool of money, you don't get a paycheck every week anymore. So your pool of money to work with is your pool of money to work with. So when trades go really bad and you have to put double, triple as much money into it to fix it, that wasn't going to work for us over the long term. So I'm now making 3 to 4 times as much just buying calls and puts than I did with spreads, with no limitations on how much I can make. Spreads have a limit on how much you can make. But this way, just buying calls and puts, there's no limitation on how much I can make. So I fundamentally do not believe in placing any trade that limits my ability to make money. And part of that mindset happened when I first started trading. The people I was around were all people who really like doing really complicated things. And I'm saying I might have been one of those people too, but I learned spread trading, complex spreads. Um, let's get 8 different legs on the spread and let's adjust this, adjust that. And when I get, it was fun. I got good at it. Um, but then I started, myself and Becky went to the Traders Expo in Las Vegas. And we started meeting people there and else and other conventions we went to where we were now around people who trade their own real money. It was a big difference finding professionals that trade their own real money and were sharing their knowledge with us. And even one of the people who ran one of the who still runs one of the biggest educational organizations teaching you how to trade option spreads, we paid, I think, $5,000. Myself and Becky paid $5,000 to go learn spread trading from this person. I won't say the name now. You can ask me offline. Some of you already know who it is. The person is a big name, still out there running one of those big option trading educational companies. But during the training, this person kept talking about buying futures or buying shares or buying Forex but he tried to push us away from option spread. So I caught him in the hallway basically, and I said, I didn't want to ask you this during the meeting, during the training, but how come you keep pushing us away from doing spreads? And he said he doesn't do spreads anymore. He told me he's teaching spreads because that's what people want to pay him for, to learn how to do spread trading. Even though he's the man to learn how to do spread trading, he stopped doing that a while ago because as he started trading bigger size accounts, you cannot get in and out of positions doing spreads in any realistically efficient way. You're going to be giving up so much on fees and commissions. You're going to be giving up so much on just the bid-ask spread. He said when he was trading accounts in the sizes of between 10 and $100 million, he got he's And he said there's no way to do that with spreads. So you got to have shares, you got to have futures. It has to be directional. It can't be spread trading anymore. And but he said people didn't want to listen to him, but they wanted to learn spreads, so that's what people would pay him for. He told him how to do spreads, but he stopped doing that himself because as he got bigger, you just can't do spreads. It becomes inefficient. Now, if you I also know people who have like a $500,000 account and they need maybe a 15 to 20% return per year to live on, and that works for them real well. They pull in 80, $100,000 a year, getting a 10, 20, 15, 20% return per year, and that's doing spread trading, and they're good with that. So everyone's different, but from how we approach things and how we wanted to work, they would need a $500,000 to make $80,000 a year, 20%. We can do that with less capital and futures between futures and options. We don't need as much capital to do the exact same thing. A lot less risk, um, a lot less headaches, easier to manage, no adjustments whatsoever. If things go wrong, your risk is limited to what you paid for the option. It's just so much easier. Um, and one more set I have in here. Real estate. Real estate is really, really good for our strategies. They work extremely, extremely well. Um, IYR, real estate ETFs, home builders, XHB. Some people, this was one of my favorites for a while. So trading real estate, because when I looked into actually, myself and Becky also looked into trading, into investing in real estate. And we finally said, screw that. It's just too much of a hassle. Let's just go to the ETFs and buy the ETFs. So here's our real estate. Here's how we invest in real estate. So I see someone coming, I'm gonna come in to the room, but here's how we invest in real estate. We buy the ETFs. And this is calls and puts, by the way, not just one direction. But our real estate strategies. Dustin, I think you're going to be doing IYR and VNQ also, right? Is that correct, or just doing the SPY, QQQ, and DIA?
Yeah, we spoke about maybe doing IYR and then the XL, the one you showed at first, yeah, XLI and XLK.
Okay.
So
So
yeah, I think
yeah,
I'm gonna look
IYR
into
is,
those as well.
yeah, extremely, extremely, extremely high probability trades for IYR and VNQ also. But IYR is excellent.
And that gives me some choices for my pricing if I can
Yep.
afford the higher price
Yeah, these are
sectors
gonna,
or at
yeah,
least these.
IYR is gonna be a lot lower price. These are gonna be like maybe $300 to $400 a contract. So much more workable. But once again, like I said, we have option pricing for everyone's account size, and other ETFs are even lower in price. And some people, yeah,
What when you said that you got around traders that you were used to trading their own money.
yeah.
What is that? I mean, aren't you trading your own money now? Like what? I don't
No, no,
understand
the
that.
people we learned from were were trading schools.
Okay, gotcha.
Yeah, they
Okay.
weren't trading their own real money.
Okay, got it. Got it. I was like, oh, aren't we doing that now? Okay, I gotcha. I
Yeah.
gotcha.
The difference is anything you see, we actually do trade.
Okay, with our
That's
own money. Yes, yes.
that's
Okay.
the difference.
Okay.
And it really it we didn't understand that when we first signed up with our very first training, and it was Invest Tools. It was a good training. They say you buy on the three green arrows, sell on the three red arrows, right? That sounded great. Um, and our first trade was UNH. We bought I bought $5,000 worth of call options on my very first trade. Within a month, it went to zero.
Oh, oh.
You see, the trading school never told us, well, only allocate a certain percentage of your account to a trade. They never told us stuff like that. Otherwise, it would have been maybe $500 or something, or that type of thing being allocated to the trade, or much less. They never told us that. We didn't know that. So we just went all in, and Becky did the same thing. And that was our first big loss, both of us. It literally wasn't until we went to Trades Expo and was around those other people trading their own real money that we learned about trade sizing.
Okay.
Um, and that was a great experience being around those people because you weren't finding And I learned eventually to ask people the right questions who were presenters. There were people who would come out here and I'd go there and wherever it was. We travel all around the country. And I would ask them, I don't want to embarrass them in front of the crowd, so I asked them offline, can you tell me what you really trade in your account? And if what you present today is stuff that you actually trade, they're like, no, we don't trade this. We don't trade double diagonal spreads. We don't trade calendar spreads. Most of the people literally only traded covered calls in their own personal accounts. That's it. They got a stock portfolio like a lot of people do, and they traded covered calls against it. That was the reality that most people did. One guy from Thinkorswim, he one of those people who did a lot of the presentations, and I asked him what he does in own account, and he says um, he shorts naked calls. That's what he does. Basically, he does exactly what he tells people not to do, but he said he does it because he has the skill and knowledge to know how to adjust it when if and when it goes bad. But he could never tell anyone what he actually does because he tells everyone to not do that. So he sells naked calls. But so I always ask people. Another person was came out here and did some spread workshops. I'm not sure. I don't recall who they were representing. It might be in one of the exchanges. And I asked them once again in the hallway, do you trade any of this stuff? They're like, no. They were just paid by the exchange to come and do an educational presentation on the topic. And that was the difference between finding the real people that trade their own real money and people just educators. It's a big difference. One of the people who we met back in Options Express days, the person who was actually in charge of trading and trading education, the person in charge of all of that, he could not be in the market beyond the close. He could not trade. He did not have the psychology to have a position open in the market overnight with anything. But he was a great educator. But I asked him straight up, "What do you actually do?" And he's like, no, he doesn't trade that stuff. But he's a good educator to show other people what to trade, how to trade, that type of thing. So that's why I always ask people, what do you actually trade? And then I can actually get a feel for what your knowledge base is. Not that they don't have good information, but I need to know that have been in my shoes type of thing. And so they have a little more empathy from what I'm going through or might be going through and can relate to us as traders trading real money. So anyway, this isn't so you have an idea for the percentage wins and how we track this, and we do this every 3 months update, send it out to all the coaching clients. Now, some people always ask, how much money do you actually make? So some of you have seen this before. One of my coaching clients was my very first one. How I started coaching, I didn't have any intention of doing this, but I was doing presentations for local option groups, 3 a year since 2007. And back in 2014, one of the people in the groups wanted me to coach him. I'm like, I don't want to coach anyone. But he's like, help me, because he explained to me a situation. He was losing a lot of money, and he needed help. So I helped him, and he did so well. He actually did one of these presentations with me and showed his live trading account. Um, and he put together all his trades. So he was so proud of his turnaround. So I'm going to show that. But it shows he actually put dollars and cents on there. And nothing's really changed percentage wise. This was a few years back, but nothing's changed as far as percentage wise. And he has notes. If you want a copy of this, let me know. I'll send you the PDF. Um, okay, so we went through the same period, October through April. That's why I'm saying it's like this is a good time. The very first trade he shows, so this is the amount of on these trades, he risked around $1,000 per trade on calls and between 500 and 1,000 on put options. The account size is $100,000 account. So he was risking less than 1% of the account on each trade, less than 1%, because he was learning. Your eventual goal is between 2 and 4% account risk. Ideally speaking, 2% account risk per trade, no more than 4% account risk per trade. So if you took a full loss, you can't lose more than 2 to 4% of your account if you're only risking 2 to 4%. This was a 1% account risk max during a learning period. So you should be able to see, let me see, where's my crosshairs? Okay. All right. So this column shows the amount made, and this column shows the percentage return on the trade. Back then, commissions were a lot higher back then. Now they're like pennies. Back then they were dollars. So very first trade he got in, he put a note on here. He got this higher return because he got in at a better price than expected, which I'll show you an example of in a little bit. By getting in at a better price than expected, where you might be getting a 10 to 20 something percent return at the first profit target, by getting in at a better price than expected, you might end up getting a 40 to 70 to 80% return at the first target because just getting in at a better price than expected. But what a lot of people don't realize is how money adds up quickly. At 80 something percent wins, money just sort of adds up and adds up and adds up. It's $100,000 account risking less than 1% of the account on every trade. Okay. And money just adds up. If a trade is meant to be a 30 something percent return, it will be a 30 something percent return. If it's meant to be a 3% return, it will be a 3% return. If it's meant to be a 1% return, it'll be a 1% return. We cannot dictate to the market what we think the market deserves to give us. It doesn't work like that, but a lot of people think they can do that and then we're losing a bunch of money. We position ourselves to profit from the markets using our strategies. We don't know how much we're going to make with options. With futures, yes, we do. With futures, we know how much we're going to make and we can plan ahead. With options, we do not know how much we're going to make, but we know as long as we're consistent with our trading, we don't make too many mistakes and we cut our losses down, the profits take care of themselves and the profits add up. They add up big time. Some people see, well, I only got a 1% return on this trade. That's someone who has their blinders on and they're only looking at one trade. Well, what about the other 20? Oh, other 20 trades. A lot of people don't think like that. They focus on that one trade and nothing else. No, you gotta look at the big picture of your trading and how money just adds up and adds up, especially when you're not having a lot of losses. Your goal, ideally speaking, between 8 and 10 trades a month in an ideal world. It might be less depending on your funding, but 8 or 10 trades a month is ideal. This person did that. He got in between 7 and 10 trades a month. We have maybe 20 something valid trades a month. Not all are ideal because of open interest, option pricing, and so forth. So you have a lot of flexibility. You can pass on this one, take that one. He didn't try to get in at a better price than expected. He just got in at the open basically. And then manage the position. So let's keep going down. So after 7 months of trading, yeah, we have a small loss from time decay, minus 9%. There are also those people, I have one person literally right now who was negative a few dollars with negative 10%, but all they saw was, once again, but I took a 10% loss on this option. Okay. The other trade, you got a 25% return, right? Yeah. So on one trade, you lost 10%, and the other trade, you made 25%. So you made $2.50 for every $1 you lost, basically. Yeah. It's money's made versus money's lost. On one trade, he made 25%. On the one, he lost 10%. You made $2.50 for every $1 you lost. Do that all day long. Anyone should be able to do that all day long, as long as you risk approximately the same amount on every trade. If you risk $1,000 on one trade, 2,000 another one, 500 another one, 4,000 another one, you're gonna get destroyed because you take a loss on the one where you risk 3,000, but you only make profits on the one where you risk 500. You can't make your money back. You keep your trading risk around the same amount on every trade, and the numbers work themselves out very, very nicely. Okay, after a few months of trading, same type of thing, just consistency month after month. So this is one of the first few people I work with, and I just had him do what I tell you to do, follow the rules, and you're going to see the results. And he committed to it. He was so proud of his trading that he did a presentation with me. This was after first 7 months. It was a 15 to 1 return, which is ridiculous and not normal. But that, once again, the period we're in right now, that's why I always say this is a great time for this type of trading. Book your profit because losses happen. It's a 15 to 1 return, almost 16 to 1 return. Okay. After one full year of trading, he had six more losses total, and this became a 6 to 1 return. So it was 6 to 1. You always hear about risk one to make three. Well, we make 3 to 6 for every one lost. Okay, so his end result after a full year of trading was a 6 to 1 return. He made $6 for every $1 lost. We don't try to risk one to make three. We try to make three for every one lost. That's the goal, is actually to make three for every one lost. Same thing with the futures. We'll make $3 to $5 for every $1 lost. We don't risk one to make three. Show me the people who think like that, and I'll show you people who have had troubles. This is a lot harder. And we do this by having very high probability trades and let our wins offset the losses, but the consistency, keep booking profits, keep booking profits. As humans, psychologically, it's hard for us to take a lot of losses and keep going, even if in the end it would work out just fine. It's hard for us to do that as humans, take a lot of losses. So what time it is? All right. Okay, so, but anyway, this was after a full year of 6, 7 months of trading. After 1 year, it came out to 6 to 1 return, still really, really good. So, um, but this gives you a feel like if this is 1% of account risk, then double this number for 2% account risk, triple this number for 3% account risk, keeping in mind this is a $100,000 account. Okay, $100,000 account at 1% account risk per trade, being very consistent. And eventually some more losses kicked in, six more losses total. And so the numbers came out to 6 to 1 return, $6 made for every one loss, which is extremely, extremely, extremely good for any type of trading. 6 to 1 return. Okay. Outrageously by following the rules. And that's key, follow the rules. And if you just focus on the S&P, NASDAQ, and Dow, that might even be higher. Okay, so any questions on that so far? So you have a feel for dollars made versus dollars lost. And nothing's really changed over time as far as that goes. I'm going to change the share.
I have a question, Eversley.
Yeah.
Which one of our templates shows like a moving average with the 40 period and a moving average with the 8 period?
You have the 40 on every template.
Yeah,
The
got the
8,
blue line.
yeah, you have the 40 on every template you have, and you can just add an 8.
Oh, I can just add it.
Yep. And
Okay.
in any template you have, or make up your own. Oh, you haven't made your own yet, have you?
No, I have not yet. Yeah.
I think I know what Dustin's going to be doing Sunday afternoon
Okay.
before the game.
Yeah, it's a good thing we got a night game.
Yeah, so
So I'm here.
Dustin will be home watching the game.
That's right.
But you're gonna have at least a 2 hour window to like maybe make up your own chart or take one of the existing charts, add a moving average to it, and then save it by a new name.
Okay.
And it's not that big a deal at all. So but you can try an 8 EMA or 8 SMA, and then you always see which one fits the pricing best. I think this one is EMAs. Yeah, this is an 8 EMA, exponential moving average.
Okay. I just go into the indicators and add it through there
You got
on
it.
the Ninja Trader. Okay.
And then
Got
adjust the
it.
colors to whatever you want, then save and save the template.
Right on. Thank you.
All right. Okay, so I'm going to change this and I'm gonna do this really fast, but there's one strategy we go over sometimes. So we'll touch on that. This is a chart of the S&P. Here was that big pullback last week. This is the uptrending 40 period moving average. So right now we pull back hard to the 40, close below it, but we're kind of chopping sideways. Squeeze, we're kind of losing momentum. And like I said, we have multiple sell signals on everything right now. So I'm looking for this to actually pull back even. But that first test is a bounce. This is a daily 40. I'm looking for this to pull back and go lower. Um, but right now, we have just this massive uptrend. Okay. So now I'm going to show you the Donchian cross, which some of you have seen. And this is the Donchian mean line, this orange line, and the blue line is our 40. It's a simple trade. It's one thing is one of Becky's favorites because it's such an incredibly high probability trade. So we know what happens next. Orange line crosses the blue line. We close below this upper Bollinger Band. This is a Bollinger Band. 88 to 90 something percent wins going upward of the bullish trade when we get this scenario.
Which one is the Bollinger? Is it the dotted?
Yes.
Okay, thank you.
And I think, let's see, this is, I don't think this one's standard setting. This one is 20 and 30 rather than 20 and 2. This is going to be 30 and 2 rather than 20 and 2. So a different setting. It's a little bit wider. But yeah, if we get a close above the Bollinger Band, we usually pass on those trades because it's really extended and there's a good chance it's going to pull back. So we close below it. And how we determine a target, we go with volatility. Um, Volatility, not of the option, of the underlying ETF. And we use ATR. So the ATR and we use the 5 period. So this is telling me, if you take a look at the data box right here, the ATR for this day is $10, 10.38. It's telling me SPY on average is moving 10.38 points every 5 days. It's a 5 period ATR. Our first profit objective is going to be based upon the open price of the ETF the next day. So the open price is 579.19 the next day. Add to that 1038. So it's going to be 589 something. This high is, so sometime this day, the target will get reached 3 days later. So I get my signal here. Here's a crossover. And if you can't always tell with your eyes, you look at the data box. On this day, orange, blue. On this day, the orange value is less than the blue line. 544 is less than 549, so we didn't cross bullish yet. On this day, the orange line is greater than the blue line. We cross bullish. You can't always tell with your eyes, so you look at the data box to confirm. Close below the Bollinger Band. There's some other criteria also. I'm not going over now. I'll go over that in detail with coaching client, but other details. But we know based upon this day, the volatility is 10.38. We're not doing option analysis. We're doing the analysis on the underlying ETF. We're using options to capitalize on the opportunity. We're taking it in a very simple way to use options. All of the analysis is on the underlying ETF. We're going to take the first in the money option. If the market opens the next day at 583.41, the first in the money option is most likely 582. Oh, excuse me, 583 is most likely the first opening, the first in the money option on the call side. Sometimes it might go every 5 points, and so it'll be 580. And it's either going to be 1 or 2 months out of time. Time-wise, it's going to be 1 or 2 months away. So the expiration will either be over here or over the next month. Or it'll be in this month. So the trading plan will show the win-loss stats if you have the expiration 1 month out, and the trading plan will show the win-loss stats if you have the expiration 2 months out. The further out you go, the more upfront cost you pay for the option. The less time you have, the less you pay for the option, but you have less time. So the higher a risk of getting a loss, of it expiring worthless. So those are business decisions you make. You know what the win. 1 month might be 85% wins. 2 months might be 93% wins. Are you willing to pay a little bit extra for some more time to have an 8% higher probability of having a winning trade, but make less? Or are you willing to accept an 8% less chance of having a winning trade, but you make more if it is a win because you're paying less upfront? Those are your biggest business decisions you have to make. I already know the answer. Dustin, which one are you taking?
I'm always going with 2 cycles.
There you go.
More time is better.
More time is better. You don't, um, more time is better. You're going to make a little bit less, but in the big picture, if you were to pick up an extra loss here, now you need several wins to offset it. So you're digging yourself an extra hole, potential hole for no good reason. Um, the extra few percent dollars you might make, is it worth it? It can be. But what I found out is the more conservative you are and the more time you give yourself, the more money you will make in the long term. The more money you will make in the long term. That's straightforward. And Dustin has done really well with the future. He started trading futures earlier this year, I think it was, and he traded during the times when it was rough, February and March was rough trading for the futures, but you get through that, and then all of a sudden you start making money, and it's like the numbers work themselves out. So there'll always be a time each year where there'll be a month or two where it's rough, and then the rest is great, and everything just works. The numbers work themselves out. This setup happens all the time. Crossover, buy, cha-ching. Crossover. This is a good one because the market opened and dropped even better. So if you can get in at a better price than expected because the market went down. So here ATR is 640. If you get in a point lower, 3 points lower, 4 points lower, all of a sudden, instead of having a 640 target, you got in for getting into the open, then it drops 4 points. Now your target is 10 points for your target because you're getting in instead of 640, the ATR, you get in 4 points lower, so now it's 1040 because you got a 4 point better entry point. All of a sudden, now instead of a 15, 20 something percent return to first target, you're up to 40 to 70% return to the first target just by getting in at a better price than expected. You get in a really better price than expected, you get in 10, 15 points lower. The thing is, if the trade is meant to be a loss, it's going to be a loss no matter what. But if it's meant to be a win at 88, 90% wins, then instead of having a small win for 20, 15, 20 something percent, now you're having a win for 70, 80 something percent. Same trade, but a much bigger percentage return. So one win getting in at this price is you get in down here and you make 3 times as much with the same risk just by getting in a better price. Maybe sometimes 4 times as much just by getting in a better price. So 10 different people taking this trade will get in at 10 different prices on any of several different days. As long as you're below the entry price and the first target's not reached yet, trades in play. You get in here, 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 this day, that day, or that day. All those days, the price is below the open of this day. You can get in any of those times. People will take this trade anytime during this period. People have lives, people have stuff to do, people have jobs, families, they're not feeling well. They may not be able to get in right there at the open. They might get in a day or two later, 3 days later, whatever it might be, as long as they're below the open. So 10 different people taking this trade will get in on 10 different days, 10 different times, and have 10 different profit levels because they'll all be profitable, but 10 different amounts of profit because of when they chose to get in. Like I
Hey,
said,
Everton,
yep,
I
yeah,
got a question for you.
yep.
When if you take that trade, let's say you bought it at the open and then it just keeps
Is
going
this
down.
coaching
You
client
ever,
Aaron or different Aaron?
this is the same old Aaron.
Okay.
Yeah. If you buy it, say you buy it open and it just starts going down, and you're like, oh well, do you ever buy more options when it goes
Okay.
down?
This topic came up back when in 2008 when I was actually during that big market volatility, learning from John Carter, watching John trade. John did this stuff live with real money. Key is with real money. So because the volatility was so high and knowing what option prices were, everything, and the futures for everything was just big dollars, right? So if you plan ahead and depending on how many contracts you normally trade, say you normally trade $2,000, right? And that can give you two contracts, okay? What some people would do is get in one contract right at the open, so you're in, and you hold to get in on a second contract on a pullback. But you have to be trading big enough to be able to do that. So let's say you were able to get in 2/3 of your position at the open, but you might save 1/3 for later on, whenever that later on is. There's no just anything better than the open. See what I mean?
Yeah, so say if you're risking 2% or something, you can just do 1% up front and then the other percent if you see a pullback or something
Correct.
like
You
that.
just get it, even if you get it a day later at 2 points better, or the same day at a point better, it's still an improvement, right?
Yeah.
So that is what I would recommend if you have the resources to do that, and you do have, because sometimes you're just real sketchy on, like someone asked earlier about what if you have multiple positions valid on the same day, same type of thing. You may get in a partial percentage. You might get in 1% on this trade, 2% on that trade. If it pulls back a little bit, you get another 1% on the that type of thing. But you never at any time exceed your total max risk. If your total max risk is 3% of the account, your trade should not add up to more than 3% of the account, basically. So you have to just allocate accordingly.
Great. Thank you.
Right. I said this keeps going back and it just goes on, and every time we get a crossover, it goes up, and it happens over and over again. Trade happens over and over again. This is our Donchian cross, one of our favorite strategies. It's one of six. I've shown other strategies during the meetups. If you went back and looked through the um, YouTube channels, you'll find some others, but this is the number one I've shown. And some people say, is this hard to do? Okay, it's real. Do you see the orange line crossing the blue line? No. A day
Yeah,
later, did the orange line cross the blue line? No. Hey, today the orange line crossed the blue line. I might have a valid trade. This is what you're going to see. That's all you're looking for, two lines crossing. And the rest is just checking it closed below the bone chip band and a few of the little details. And you have the stats that show 80 something percent wins. You know, the next day you have to get an in the money option, and I go through the stats, the details with you, the pricing. You can't pay too much or else you're screwed. Go through the targets, how to set it up, the whole deal. But that's all you're looking for. Two lines crossing is that simple. And that's how we do all of our trades. On one chart, we'll look at 7 out of the 8 strategies, and one chart for will 7 out of 8 strategies, and the other chart for market bottoms. That's the Ichimoku strategy to find market bottoms. Finding a market bottom is not that hard, but someone has to show you how to do it. Yeah. Someone was saying something?
yeah, that was me. I
Yeah.
have a question about risk management.
Yeah.
And just, like on some weeks, we may get like 20 different stock or not stocks, but like futures and ETFs that signal.
Yeah.
Um, how much of your account like do you have out there at one time?
You have to trust.
1% in each
Number
one.
one, you have to trust. Because at some point in time, you're going to have a big chunk of your account just allocated. Okay.
That's what I'm talking about. Yeah.
You already know in your futures, you may have a lot allocated, but it's mostly margin.
Right.
because you're controlling the risk with your stop loss. So that's not an issue, but it's tying up margin. And you have to keep track of how much margin you have free in your account because with futures, margin can change overnight. So if today you have an extra $5,000 in your account free, and you have, let's say, 15 tied up in just margin and 5,000 free, and then you place an option trade risking 2 grand, let's say, and now you only have 3,000 in margin. Okay,
Yeah.
all your trades are on it, and you're happy. You know your margin's good, your options are good, but then the exchange raises the margin on the same positions you have open.
Yeah.
That's what can happen. So you have to always have enough cushion in your account to allow for that, and have enough cushion in your account to always go the other way if the market changes.
And what do you think's enough cushion?
You need to always be able to place the next trade. So if you're all long, and you need to have enough money to place a couple of put options trades also. If the market turns the other way and you're all long, and your money's all tied up, you're screwed.
Right. So even
So
though I have like 1 or 2% in each trade, I
that shouldn't be
still,
that shouldn't be an issue.
but yeah, if I had everything out there,
You
if I
don't, we
have like
don't,
20 different trades.
yeah, but you're focusing on the futures, and you're focusing on the SPY, DIA, and QQQ, and that's it, right?
Yeah.
Yeah,
For the
so you
most
shouldn't,
part,
so you should not have an issue.
yeah. Okay.
If you're trying to trade everything, then it might become an issue. But you're really focused, you've dialed it in. And so if you're laying out a 1,500, 2 grand on an option trade, that's all it's tied up. There is no additional margin.
Okay. So
And
just leave
just
myself a cushion so I don't have a margin trade or a margin
just
call.
yeah, just keep enough cushion. You know what you're putting up in margin for the currency futures. Just make sure you're aware overall. And you're trading. Are you on Schwab now for the futures?
No, I'm
Oh,
still
you saw
doing,
on E-Trade?
yep, sticking with what I know.
So I know Schwab shows you how much margin you have available and buying
Right.
power. Does E-Trade show you the same thing?
Yep.
Yep. Just keep that in mind. Because once in a while you try to put on a trade, and all of a sudden this seems disproportionately high because you have an extra zero in something or somewhere. So you're
Right.
always looking at that and try not to make too many mistakes. So I think you've been doing pretty well on the futures. Same thing on options. Just keep it, double check everything. Send me a screenshot so I can verify what you're working on, and if that everything looks good, and you're good to go. And for people I'm coaching, I try to do as much one-on-one with you, including reviewing your trades and helping make sure your order looks good.
I have a question.
Yep.
With regards to futures and options,
Yeah.
for starting out, if futures you may have to concern yourself with margins and margin calls, and options you don't. How come from what I understand they're saying, oh, go with futures, that's the easiest. But in the back of my mind, it's like, but you have to deal with margins, and with options you don't. You're only putting in what you're gonna risk.
It's not something to really worry about as long as you don't make mistakes. Futures are unforgiving.
That's what I'm saying.
They're unforgiving. Options, you can screw up too, but futures are really unforgiving because you can lose a bunch of money in minutes.
Well, that's what I'm saying though. That's exactly what I'm saying. Options, you don't want to lose the money, but at least it's yours and it's like, okay, I lost my money. But with futures, why do from what I understand, oh, go with futures because that's the easy stepping in. But like you said, it seems like you're risking more in futures than you are in options.
No, with futures, you can actually, your risk is your stop loss. With futures, we have the ability to risk 100 something dollars a trade because we have micro futures. We don't have the micro options.
Okay.
We have micro futures. So you got 50 to 1 leverage with futures. You put up $1, the broker gives you 50. That's the benefit of trading with the futures. You have 50 to 1 leverage. Um, if you know what you're doing,
Yeah.
that's where we step in. Do what we tell you to do. Do it the way I tell you to do it. confirm with me you're placing the trade correctly, um, and it works. You will have your good times, your good months, and your not good months. Okay?
Yes.
But the good months will supersede the not so good months as long as but you have to get through. Like I always tell people, commit to 3 to 6 months of trading the strategies. Commit, and you'll come out the other side and be like, this is working. And with the futures, once again, you will never have to have a big loss.
Okay.
It will not happen unless you literally make a mistake. And if you make a mistake, suck it up and don't do it again. Aaron, have you made any mistakes in trading in the last year?
Oh, absolutely.
You're still here. Futures and options, or
I'm
just
still
futures?
here. Just got to move on.
Yeah,
Yeah, and figure out what I did wrong and do it right next time. Learning lesson.
yeah. I've been working with Aaron, but yeah, it's the learning curve. If you make a mistake, it might cost you a couple $100. Hopefully, not more than that, and you move on. Next time, don't do that again.
Oh, okay. And well, I guess what my concern is, it's not making the mistakes and you lose the money. I guess I'm looking at movies where it's like you have a margin call and you don't have the money.
That means you did something horribly wrong.
Okay.
That means you made a mistake.
Okay.
You made a mistake, or you took a trade that was way too big for your account.
Got
Been
it.
there, done that.
Okay.
You take a trade that's way too big, or you put your stop loss in the wrong place
Okay.
or the wrong side.
Okay.
You thought your stop loss was supposed to be down up here, and you put your stop loss down here. That's those mental things that happen, errors, and then you're like, oh crap.
Oh,
Those
okay.
are the things that happen that creates, if as long as you're following the rules, there are no margin calls. As long
Okay.
as if you have a 5 grand account and you're trading the futures, that's okay. Because you're
Okay.
trading a futures, not risking more than 100, 200, $300 a trade. That's not a problem unless you make a mistake, and instead of getting this contract where you were risking 200, you got the thing where you're risking like 4,000 by accident.
Oh,
By
okay, got it.
accident.
Yes.
Oops. You don't know
Yeah.
what oops happened until you get a margin call.
Yes. Okay. Okay.
But in Forex, they will just shut the trade down and you're screwed. Futures, they'd be like, we'd like you to wire us the money by tomorrow,
Oh,
or close the position.
yeah.
But yeah, as long as you don't make a mistake. Dustin, have you had any margin calls yet?
No, I haven't had any margin calls yet, but that's what I'm worried about. I've just never had one, so I don't know what the experience is
Don't
like.
Yes.
don't have one.
Yeah,
Okay.
Means you screwed up.
exactly.
Or stay below your futures margin when you're doing options. Just make sure you stay below.
Yeah, I've never
And
had to risk more than like half my buying power. So
yeah, always just control that, and
So there are no, I'm going to call it training wheels. Like, let's say if it's a $5,000 account and someone does something really crazy and they risk something very high. Do you mean I'm going to say there wouldn't be something that says, hey, this is a little too much for you. They just let you do it.
as long as you have the capital in your account, you can
yes,
place the trade. Yes, as long as you have the capital in your account, you can place the trade.
Oh, and if you don't have it, you can't place a
You
trade.
cannot place the trade.
Oh, got it.
But if it goes against you, once it gets to the point where your account turns negative, you get a
Yes.
margin call.
You get a what?
You get a margin call if your account goes negative.
Okay, I got you. Okay.
But
Okay.
yeah, as long as you follow the rules, and for people I'm working with, especially with futures, since they're all unforgiving, I want you to send me a copy of your screenshots. I might be online with you or in person with you. I've done both when you're placing your first trade, because you got to get it right. There's no room for error.
Well, and thank you for this because, like I said, I hear oh, it's so easy. This is the one. I'm like, wait a minute, what am I missing? You can't just be,
They both have their pros and cons. Like, we don't trade futures in December because this all of our losses happen in December because a lot of market manipulation, end of year stuff, quadruple witching, rollover. So all the basic technicals plus FOMC. So all the technicals in December are off. It's not regular technical trading. When we're all analysts and technicians, where it's not technical trading. A lot of stuff that throws everything off. What I learned a while back with one of the people I was learning from, I think it was John also, when he was day trading futures, he had it set with the broker that if his account went down more than a certain percentage in a single day, to shut him down from trading,
Okay.
automatically shut his account down from trading, and if he was day trading, and because it means something that day is going on in the market that's throwing all the charts off.
Okay.
Things are not working, but he had it pre-set up with the broker, and that was the futures broker, to shut the account down from trading if it goes below a certain drawdown, because it means something isn't working, and that's pre-established to save him from himself. Um, and come back the next day when things are working, because it's like myself and Becky learned, when the Fed's going to be speaking, everything's off because people are in a holding pattern. It's not regular trading because the Fed's going to be saying something. So we would not be day trading when the Fed's speaking because everything is off in day trading world. It's not just regular smooth trading. So we learned stuff like that. So that's why we don't day trade anymore, but it's good information learned, and that's learned through the hard way. All right. So I said we had a lot of stuff to do today, and we did. I'm going to go back to the handout. Good session today. I like these sessions where people are actually interactive and ask questions, and I'm not the one doing all the talking. That's really good. So, like I said, I put into the handout some examples of groupings of symbols. The full deal is in the spreadsheet, and we send a spreadsheet out to everyone. Here was XLI, XLK summarized. Here was the real estate summarized. Here were the energy ETF summarized, and there are a bunch more for biotech, and we have Australia ETF, Germany, Europe. So if anyone's interested in working with me, there's also a listing of just the QQQ and DIA trades from this year. Okay, and if you go on our website, you will see a lot more spreadsheets and information. If you want to work with me, let me know before this week is over, the 24th, and I'll take $250 off the futures trading program, $250 off the options. Even doing both, I'll take $750 off the combined. The details are all in the handout and on my website. So it's $1,750 minus $250, or $1,750 minus $750 if you're doing both options and futures. So both are here. Everything I do is one-on-one. I do not do group anything when it comes to coaching. The reason I don't do that is because I found out that I might have to say something to one person 3 different ways for them to understand it. Stuff I think is simple, they may not think is simple. Stuff I think is complicated, they might find easy. Some people just don't, I think they're going to get this, and they're like, I'm like, why are they not getting this? Why? What's going, they don't, and I got to look for a way. I have to think about who I'm talking to. What can I say to associate with them so they can understand this concept? So that's why I like to do stuff one-on-one, and I can get more effective learning that way. And I like to meet people face to face if at all possible. Um, like Dustin is a face-to-face guy. He likes to meet. We meet up in Santa Clara face to face. Another person I'm working with this week also likes face to face. If you can't make face to face, you live too far away, then Zoom is fine. Um, I do ask you to commit at least 3 to 6 months of consistently trading the strategies. You have to see the wins and losses happen and see how money's made and lost and what to expect. And then you come out the other side, and it's really nice. And you get through 9 months of this and you're good to go. After 9 straight months of this, you got it down. Okay, same thing with the futures, is the same type of deal. 3 to 6 months of consistently. We only trade a few indices. We trade the currencies and the major indices for the futures. And with these, we all have micro futures. So even if you have a smaller account of $4,000 to $5,000, you can trade the futures, at least the currencies, which have a very high win to loss percentage, and you can risk as little as 100 something and learn. And as your account grows, you put more money into it as you feel more confident. But you can start with a smaller account with the futures and get very, very good results. Trading smaller, and you can trade as big as you want to as time goes on, as you feel more comfortable. So both have a place. I like to do both because there are times when options are making you money and futures are not, and there are times when futures are making you money and options are not. But when you have them both going on, it's sweet. Um, and this year has been very good for options. I know we spent a lot of time, but you've seen what the spreadsheets look like. It's all wins. I'll show you the other one also, but we're going a little bit over now, so we're right at about 90 minutes. So, do we have any questions? All right. So probably going to do 2 more meetups this year. We haven't done futures in a while because I've really been wanting to focus on options because of this time of year. So the last 3 meetups have been all on options because the time of year is still key for the options trading. That's why I really wanted to focus on that. Um, because we want to get this going and keep it going right through the beginning of next year. Great times to book profits. We have the biggest trends. It doesn't matter if it's uptrends up or trends down, but we have some nice big trends. And showed you where the market was. We're going to have a pullback eventually. That's going to be a nice, scary down move all the way back to support. But those are nice moves that give us nice profits. And then when we reach support, the next big up move again. So that'll probably happen early January, maybe. So we get a pullback and then the next rally. So we're looking at some really good trade next few months. So if you want to work with me, let me know pretty quickly, and I'll give you the discount on that, and we can get you started right away. And like I said, one-on-one, and it works well for me and everyone I've been working with so far. And you can contact me via phone, email, text, whatever you need to, and I'll work with you and whatever you need to get done, and we get it done. All right, unless we have any questions, we're going to call it a day. Probably have another meetup the beginning of November and one the week before Thanksgiving, and that'll be our last 2 meetups for the year. We'll do one on futures and one on options. And we'll get you going. So call me or email me. You have my information. You can go to my website also. I can contact it. My information is at the bottom of the handout here, and also on the front page, and also my website is behind scenes, so you can go to my website also, and all the details are there, and some videos and other links and historical trade data. Let me put that link back into the chat window. So the way you see the handout, that's also my website with all the links and everything and coaching details. All right. And I'll see you all in another 2 or 3 weeks.
Thank you.
Thank you.